If you can master this smooth HEIKEN ASHI COBRA system, you'll be able to make so much more money from trading. Hey guys, welcome back to another episode. In this video, we'll walk you through one of the simplest and most lucrative trading strategies using the smooth HEIKEN ASHI COBRA system. This strategy is beginner friendly and has the potential to yield significant profits. Once you do master this strategy, it's highly profitable and you can make adjustments to this to make it even better. So, let's dive in and explore the steps together. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. And don't forget to share this video to show your support. Let's start with the basics. The 50-period smooth HEIKEN ASHI helps us see the main trend. When prices are above this line, it's a good time to think about buying. If the price goes below this line, it might be a good time to think about selling. Why do we choose smooth HEIKEN ASHI instead of moving average? At first glance, smooth HEIKEN ASHI might seem similar to moving average, but there's actually a significant difference between these two indicators. So, I'll explain why we prefer smooth HEIKEN ASHI in this strategy over moving average. However, it's important to remember that the advantage of the smooth HEIKEN ASHI indicator over moving average depends on specific situations and trading goals. Each indicator has its own advantages, and whether one is better than the other depends on the trader's preferences and the market conditions. However, I can highlight some reasons why some traders might prefer the smooth HEIKEN ASHI indicator. First, visual clarity. The modified candlestick patterns of the smooth HEIKEN ASHI indicator can make it visually appealing and easier to interpret, especially for traders who prefer candlestick charting. Second, reduced noise. The smooth HEIKEN ASHI indicator smooths out price fluctuations, reducing noise in the chart. This can help traders to see the underlying trend more clearly without being distracted by short-term price movements. However, it's important to note that both indicators have their strengths and limitations. Ultimately, whether the smooth HEIKEN ASHI indicator is better for a trader than the moving average indicator depends on their trading style, strategy, and personal preferences. It's recommended to thoroughly understand both indicators and practice using them in different market conditions before making a decision. The smooth HEIKEN ASHI can be used for any time frame and market, like stocks, forex, commodities, and cryptocurrencies. When the price is higher than the smooth HEIKEN ASHI indicator, it's called bullish. But if the price is lower than the smooth HEIKEN ASHI indicator, it's called bearish. You can also figure out the candle colors. Up bullish candle, blue. Down bearish candle, red. Why the 50-period smooth HEIKEN ASHI? Of course, you can adjust this setting according to your needs. But based on my experience and analysis, 50 is the best period for smooth HEIKEN ASHI because it can accurately read the market trend, whether on shorter or longer time frames. Even though banks and institutional traders generally use the 50-period moving average, I believe the 50-period smooth HEIKEN ASHI is better at reading market trends compared to the 50-period moving average. How to use the smooth HEIKEN ASHI indicator? Using the smooth HEIKEN ASHI indicator involves a few simple steps to help you understand and interpret market trends. Here's a basic guide on how to use it. First, interpret candlestick patterns. Smooth HEIKEN ASHI modifies the appearance of candlestick bars. Look for these key features. Bullish trend. Blue candlesticks with small or no wicks at the bottom, indicating upward momentum. Bearish trend. Red candlesticks with small or no wicks at the top, indicating downward momentum. Second, spot reversals. Changes from bullish or blue candle to bearish or red and vice versa can signal potential trend reversals. Keep an eye on candlestick color changes, especially when they occur after a prolonged trend. Third, practice and adapt. Practice on historical data or in a demo account to become familiar with the indicator's behavior. Adapt your strategy based on market conditions and the reliability of the signals you receive. In addition to smooth HEIKEN ASHI, you can also use the HEIKEN ASHI indicator to simplify the numerous types of price action candle patterns. At the end of the video, I'll provide a link to a HEIKEN ASHI video to make sure you're no longer puzzled by those confusing candlestick patterns. However, just using one indicator isn't enough to see the whole market picture in trading. This also applies to the smooth HEIKEN ASHI indicator. To understand better, it's smart to add other indicators like stochastic oscillator, RSI, or MACD. This can really help traders in both Forex and stocks. In this plan, the smooth HEIKEN ASHI indicator just tells us what direction the market is moving in right now. We can't rely on it to decide when to start or stop our trades. Instead, we'll use both the stochastic oscillator, support resistance zones and trend lines together to help us know when it's a good time to trade. How to use the stochastic oscillator. You can use stochastic indicators to improve your day trading strategy in many ways. Here are some ideas to help you get started. The bull-bear strategy. You can use the stochastic oscillator to detect a bullish and a bearish market and enter or exit the market accordingly. If the stochastic indicator lies between 50 and 80, the stock prices are expected to move safely upward and signify a bull market. In contrast, if the stochastic indicator lies between 20 and 50 and continues to drop, it could indicate a bearish market. There may be selling pressure within traders, and it's a good idea to exit the market before you suffer significant losses. The overbought oversold strategy. This is the most basic application of the stochastic indicator. Many traders often use the stochastic oscillator to determine if a stock is overbought or oversold. If the stock is trading above 80, it could be a sign that it's overbought, and there is a possibility of a reversal shortly. On the other hand, if the stock is trading below 20, it could indicate that it's oversold and could also lead to a reversal of the trend. Many traders buy stocks in an oversold market and sell stocks in an overbought market. This strategy is often referred to as mean reversion trading, which could be used by traders who want to take advantage of short-term price fluctuations. However, it's critical to be aware of the potential risks associated with this strategy. It's a good idea to make sure that you do your research and assess the risk before employing any strategy. The divergence strategy. Divergence is an extremely effective trading concept. Divergences, according to George Lane, the creator of the stochastic oscillator, were the best stochastic strategy of his momentum oscillator. He believed that price momentum frequently reversed prior to an actual price turn, providing important insights to technical traders. Support resistance zones and trend lines. Technical analysts use trend lines and support resistance levels to identify price points on a chart where the probabilities favor a pause or reversal of a prevailing trend. Support occurs where a downtrend is expected to pause due to a concentration of demand. Resistance occurs where an uptrend is expected to pause temporarily due to a concentration of supply. These levels, while they may appear arbitrary at first sight, are based on market sentiment and anchoring. Here, we examine how support and resistance zones are largely shaped by human emotion and psychology. The psychology behind support resistance zones and trend lines. In a given financial market, there are typically three types of participants at any given price level. First, those who are long and waiting for the price to rise. Second, those who are short and hoping the price will fall. Third, those who have not yet decided which way to trade and remain on the sidelines. As the price rises from a support level, the traders who are long are happy and may consider adding to their positions if the price drops back down to the same support level. The traders who are short in this situation are beginning to question their positions and may buy to cover, exit the position, to get out at, or near, break even, if the price reaches the support level again. The traders who did not enter the market previously at this price level may be ready to pounce and go long if the price comes back down to the support level. In essence, a large number of traders may be eagerly waiting to buy at this level, adding to its strength as an area of support. If all these participants do buy at this level, the price will likely rebound from the support once again. Price can, however, fall right through the support level. As price continues to drop, traders will quickly realize that the support level is not holding. The long traders may wait for the price to climb back up to the previous support level, which will now act as resistance, to exit their trades in the hopes of limiting their losses. The short traders are now happy and may consider adding to their positions if the price revisits the price level. Lastly, the traders who did not enter the market yet may go short if the price comes back to the previous support level in anticipation of prices dropping further. Again, a large number of traders may be ready to make a move at this level, but now instead of buying, they will be selling. This same behavior can be witnessed in reverse with traders' reactions to resistance levels. Smooth HEIKEN ASHI COBRA trading strategy. After exploring all the components of this strategy, we'll now delve into how to combine all the tools and rules into a single trading system. Once again, if you can master the smooth HEIKEN ASHI COBRA system, you can potentially earn more money from trading. This is because all the tools we use can read price action, market trends, market psychology, and market momentum all at once. Therefore, it's important to follow the step-by-step instructions, as there might be a few slightly complicated things, especially when it comes to stochastic oscillator trading rules and the concept of support resistance. Let's look at a few real-life examples. On this chart, it's easy to see that the price is currently moving below the 50-period smooth HEIKEN ASHI. This points to a downward trend. So, we're focusing on finding opportunities to sell. We do this by combining the stochastic indicator when it's showing an overbought condition and looking for points where support resistance zones and trend lines break in a bearish direction. As we can see, the stochastic oscillator is above the 80 level. This means that even though the trend is down, the price temporarily goes up and becoming overbought. This often suggests the market could go back to its downward trend. But then, the stochastic oscillator falls back under 80. This could be a signal for traders to think about opening a sell position on the next candle. However, in this strategy, we need extra confirmation from market psychology, which comes from a break in a trend line. Here, we can clearly see a short-term trend line that was going up, but it's then broken by a big price drop. This breaking of the trend line is a valid sign that the market is still on its downward path. In this strategy, the break of support resistance zones and trend lines is a very important requirement. This shows the current market psychology. Therefore, it's crucial to clearly and accurately read the support resistance zones and trend lines forming in the market. Don't force it. If these zones and lines aren't visible, traders should step away from the market and wait for a new signal that meets all the conditions set by the trading rules. In this case, all the trading rules have been met perfectly. So, on the next candle, we should enter the market by placing a sell trade. To be safe, we set a stop loss above the highest point of the smooth HEIKEN ASHI candle. As you can see, the price then continues with confidence in the downward trend, and this continues up until the moment this video is being recorded. On the other hand, let's take a look at this chart. Here, we can easily see that the price is moving above the 50-period smooth HEIKEN ASHI. This shows a positive, bullish trend for now. So, our focus shifts to finding opportunities to buy. We do this by using the stochastic indicator when it's in the oversold condition and looking for moments when the support resistance zones and trend lines break in a bullish way. As we can notice, the stochastic oscillator is under the level of 20. This indicates that during this upward trend, the price goes down temporarily until it becomes oversold. This often suggests the market could return to its bullish trend. As we can see, the stochastic oscillator goes back above the 20 level. With this signal, traders might think about opening a buy position on the next candle. However, in this strategy, we still require confirmation from market psychology, which comes from a trend line breakout. Here, we can very clearly observe a short-term downward trend line that's later broken by a strong bullish candle. This break in the trend line is a reliable sign that the market is continuing its bullish direction. So, for the next candle, we could consider entering a buy position. To be cautious, we place a stop loss below the lowest point of the smooth HEIKEN ASHI candle. As you can observe, the price then confidently maintains its bullish trend, and this continues up to the present moment when this video is being created. From the two real-life examples we discussed earlier, it's clear that this strategy is very strong because it involves price action, market trends, market psychology, and market momentum all together. You can manually combine all the indicators I explained on your trading platform, as it's really easy to do. But if you need the exact settings shown in this video, you can download them from the description section. In this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Here are other examples of smooth HEIKEN ASHI COBRA trading to fully understand this wonderful strategy and to make the most out of it. Alongside smoothed HEIKEN ASHI, you can utilize the HEIKEN ASHI indicator to simplify the many kinds of price action candle patterns. Here's the HEIKEN ASHI video you should watch to ensure you're no longer puzzled by confusing price action candlestick patterns. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video to show your support. See you next time.